Good morning to all. We will start the meeting with the recommendations and then technicals, and then Karthik will take the current market scenario presentation. First, recommendations for this month. We are recommending mainly three blue chip companies due to uncertain market conditions. First, we are recommending HDFC Bank. As you know, it is one of the best fundamentally strong bank. And also the HDFC Bank and HDFC merger will have its benefits for HDFC Bank. And also it's come from around 1,725. Now it's trading around 1,290 to 300 levels. So you can buy HDFC Bank as one of the most fundamentally strong bank. Then Infosys. The Infosys result for the last quarter was below expected line due to one-off issue. So it's came down from 1,950 to 1,500 levels. So the management commentary is good, and they are seeing very good order booking in the later quarters, the coming quarters. And also the rupee depreciation have an advantage for the IT companies. So you can buy Infosys and the IT bank. The third one is M&M. Most of the automobile companies are facing this chip issue, supply concerns from the chip issue. So they are not able to produce more vehicles. But M&M main the product is tractors, farm equipments like tractors. So for that category, the chip issue is not a matter. So they are not facing any supply concern in farm equipment. Also, meteorological department IMD is predicting very good monsoon this year also. So agriculture will be good this year. So tractors and other farm equipment sales will be good this year. So you can buy M&M at current levels. And next one is Spectra Food. The IPO of Spectra Food came last year. It's one of the famous company in North India, like Krivika biscuits and English Oven bread also. The valuation of the Spectra Food is around below 30 P only. Most of the FMC companies are trading at higher levels. So at a reasonable valuation, also the result of Spectra Food is also good. So one can buy Spectra Food in FMCG pack at this levels. Last one is Gujarat Gas. Gujarat Gas has posted very good result the last quarter. It is one of the famous city gas distribution in Maharashtra and Gujarat. So the city gas distribution is one of the growing sector in India. So one can buy Gujarat Gas at this level as the company is posting very good results. For the April month review, most of the stocks came down due to bad market conditions. One of the recommendation, Coromandel International almost touched the target. Now we have given target of 930. It touched around 928. But most of the companies are fundamentally very good companies. Once the market rebound, it will hit the target. So one can hold all these companies. It's came down only due to bad market conditions. Our portfolio down by 13.5%, while market Nifty came down around 11.3%. So it's slightly underperformed the market, but one can hold the companies and for the near term. And next, technicals. The last meeting, we see the market was moving in an upward channel, this channel. Now, due to the sharp correction, the market is moving in the downward channels. It is taking around the bottom of the channels. Once it breaks the bottom of the channel, then it will the fall will be little more. So it's within this downward channel. Another market which lost most of the investors' wealth is Nasdaq. Nasdaq fallen by almost 50% from the 2020 low. This COVID from the COVID low to recent high. That uptrend, it has lost almost 50% of the uptrend from the COVID 2020 lows. From the 2020 lows, it has rallied in 2021 and 22. It's hit almost its high during this March, and now coming down from the March due to US market, higher inflation and higher interest rate in US. So most of the technology stocks are trading at very high valuations. So they are coming down from their recent highs. And overall, the Nasdaq index has fallen 15% from the highs in which hit during March 2022. But Nifty has fallen around 27% from the recent highs. So there is a chance for more market corrections. But one positive thing is that Nifty is having support around this level. This level is around 23% of the retracement levels. So Nifty is taking support at these levels. Mid cap has fallen almost 27% of the recent rise. And it is also taking a good support at the current level of 27,000 figures. Then is small cap index. Small cap index has fallen more. It has fallen almost 38% of the recent high from 2020 March to 2022 March. So it has fallen almost 38% from the recent highs. When we are seeing the chart, Nifty is trading. Nifty is now moving in a consolidation phase. If it breaks this level, then we can see a bear market also. Now, due to this uncertain conditions, Nifty can go for a consolidation, or it can break at this from this level and will see a very severe bear phase. So these are the critical support to watch. The first support is 15,650 and 15,450. These are the two strongest nearest support. The Nifty, if the Nifty holds these support means the Nifty will move in a consolidation phase. If it breaks 15,450, then we can see more bear market. So the strong support will be around 14,200. So we have to look for the near-term support of 15,450 levels. We hope that it will hold at this level. If it breaks that level, 15,450, then it will be a bear market. Thank you. Now, Karthi will take the current market scenario presentations.
Good morning. We will see the current market scenario presentation. Usually, we used to get around 180, 190 participants in our second Saturday meeting. Today, it is just 105. This indicates the interest has gone down among retail investors between last meeting and this meeting. The main reason is that market has fell very sharply. And we are seeing huge sell-off in mid and small cap stocks. Our market was somewhat holding on, but after the RBI hiked the interest rate, surprise out of turn meeting, our markets too fell very sharply in line with the US markets. And overall, if you see across the board, market has come down. And the main reason it is told is that the culprit is the inflation. So globally as well as locally, if you see, all central banks have started hiking interest rates to fight against inflation. Inflation has gone up very sharply. In the US, it is more than 8%. And in India also, day before yesterday, we got the inflation data, which was higher than expected. And it also nears to 8%. And if you see the repo rates and global US Fed rate and all, there is a big gap between the actual inflation and the rate, which means that most of the countries are in negative interest rate scenario. That means there is a scope for further hike in interest rates in coming days. And if you see the last two weeks, mid and small caps fell very sharply. In fact, some of the stocks has come down by 30-40% in a matter of 2 weeks. And globally, if you see one of the worst performing market index is the Nasdaq, where majority of new generation companies were listed and many loss-making companies were there. And if you see that in the last 7-8 months, many companies has fell by as much as 80%, 90% like that. Even some of the FANG stocks, where companies like Netflix, from a high of more than $600, it has come to around $160, $170. That is a fall of more than 75%. So Nasdaq is in a bear grip, where many stocks are down and index is down by more than 20%. And here in our market, if you see, Nifty has come down by around 16-17% from the peak we have seen in October, whereas mid cap is near to 20% down, whereas small cap, if you see, it has come down by more than 25% from the October highs we have seen. And in the last 1 month, Nifty Sensex were down by 11%, mid cap by 13%, and BSE small cap by around 15%. So overall, it's a bloodbath market, and we are seeing a lot of stocks falling on a daily basis. In fact, yesterday everyone was expecting a pullback rally. In the open market went up, again market closed in a red, and bulls got battered by the bears. So it's a very difficult market, and retail investors got stuck with many scripts, and they don't know what to do it. And the mood is also extremely negative. If you talk to people who have invested, I'm telling about the mutual fund managers and PMS managers and professional managers. Most of them are extremely bearish. They feel that it will take another 3-4 months for the market to get bottom out, and after that some consolidation is expected. Then after that only market will go up. And many of the mutual funds surprisingly holding a 10% cash, 15% cash in their funds. It's a rare. Mostly they used to remain invested, majority of the funds, with more than 95% investment. But when I see some of the mutual funds, they are holding 10%, 15% cash in their mutual fund schemes, which indicates that near term they are extremely bearish. So when most of them are bearish, we will see whether any contrarian will happen. Only time will tell. Right now the mood is extremely bearish, and many are sitting on cash, and some of them are even selling now and converting into cash on fear of further fall and to stop loss. So the RBI has hiked repo rate. So that is the big headlines in the last two weeks. And what is more surprising is that just in previous meeting, RBI told that growth is happening and inflation will come under control. But in a out of turn meeting and in a surprise move, RBI hiked the interest rate by 40 basis point and CRR by 50 basis point. So the hike in CRR by 50 basis point is going to suck out some 80,000 crores of liquidity from the market, and a hike in 40 basis point will make most of the EMIs costlier. So it's going to be the first hike by RBI after COVID. During COVID time, they reduced the interest rate sharply to bring back the demand. Now this is the first rate hike by the RBI after COVID. What is more surprising is the timing of the rate hike, because in June we are going to have policy meet, monetary committee meet is there. But before that, RBI hurriedly hiked the interest rate. That is what surprised the majority of the market participants. And from that day onwards, Nifty has been falling very sharply. Before that, somewhat market was holding on, and from the day RBI hiked the interest rate, mid cap started collapsing, small cap started collapsing, and even index stocks started selling huge sell-off. The reason told by RBI is that inflation is going up, and the other thing is that global central banks tone have started turning very hawkish. Particularly in US, if you see, Jerome Powell is extremely hawkish, and he is telling that we may have a hard landing, and they are going to fight the inflation. And reducing the inflation is the first priority now. That means that they are going to increase the interest rate very sharply than previously expected. So in US, next meeting, we are going to have another 50 basis point. After that, another 50 basis point is going to happen. That is already he clearly told, Jerome Powell of US Fed, he clearly told. And here also, it feels that RBI is going to hike interest rate in next 2 meetings. Suppose if RBI keep on holding lower rates here, and if say US increasing rate, means what will happen is that the collateral damage will be seen in our rupee and in forex reserves. Rupee would have weakened significantly, and forex reserves would have started depleting much faster. Even now, forex reserves is coming down. If RBI hasn't increased the interest rate, means then the depletion will be much faster, as well as the rupee weakness would have been much faster. So that is the reason why RBI increased the interest rate in an unscheduled meeting. So inflation is the keyword we are hearing from all investors, and everyone talks about inflation now. So the culprit for the current bear market is almost is 100% inflation, because if you see some of the European countries and US, where in the last 10 years where there was no sign of inflation in spite of huge liquidity there, now they have started seeing 8% inflation, and in US and in UK, the UK central bank has projected that in UK inflation will touch 10% soon. So like that, the inflation is running very high. In our country, we generally don't care much about inflation, because as I told in the previous meeting, we born with inflation, and we live with inflation, and we die with inflation. In India particularly, because we are a growing economy and population keeps on growing up, and we have current account deficit. So inflation is not a matter to us, because we always live with inflation. Whereas for Western countries and US, inflation is extremely important for them, and the main mandate of the central bank for in their respective country is to control inflation. And now inflation is gone out of whack, and so they are taking inflation very seriously, and they have started increasing the interest rate. So if inflation comes, the inflation, one is by reducing demand, and second one is by increasing the supply. That is the only way to reduce inflation. So if you see the supply side, the supply generally you can't increase immediately. The main supply side problem now came mainly because of two reasons. One is due to the COVID time, majority of industries were shut down, so some supply shortage happened at that time. Now after that, this Ukraine-Russia war, that also has disrupted the global supply chain, and that also has affected the supply. So supply is very low now, and to increase the supply, it is not possible. For that, the war has to come to an end, and gradually only we can increase the supply. Whereas on demand side, we can reduce the demand by increasing the interest rate, and that is what the global central banks are doing now. So for reducing the demand, the US Fed and all started increasing the interest rate on one hand, and on other hand, they are going to reduce the liquidity also in coming months. So the dual action they are taking. So the impact of the reduction of the demand, what is going to see on the economy is that economy may perhaps go to recession in US next year. That is very much possibility is there, and many economists are also forecasting it. All this will depend upon the data which are coming in next 6 months, and we have to see how the inflation pan out. In between, suppose if there is the end of war between Russia and Ukraine, and if energy price starts falling, means there is a possibility of US Fed taking some linear action in coming months. So all this will depend upon the data, but right now US Fed is very adamant to reduce the inflation rate. That means they are going to reduce the demand by increasing the interest rates. The next question is, how much rate hike more to come in our country? If you see, already 40 basis point RBI has increased interest rate on May first week out of turn meeting, but everyone now asking how much further rate hike is possible in our country in coming months. So in my view, if you see that another 100 basis point possible in the next two monetary policy meeting is in next two monetary policy meeting. So next meeting is scheduled on June, and that 50 basis point hike is going to be certain. August, there is a possibility of either 25 basis point hike or another 40 to 50 basis point hike is possible. So overall, around 75 to 100 basis point hike is possible in the next two RBI monetary policy meeting, which will take the repo rate to pre-COVID level rate. So that is, two stages are there. First, the repo rate has to go to pre-COVID level rate, and the next stage is that right now the inflation is higher than what we have seen during pre-COVID level. So to tackle that inflation, another 100 basis point is possible. So overall, minimum 150 to 200 basis point is possible in a repo rate in next 6 months. That is in current financial year. So this is the repo rate chart, and if you see that in 2008-9 it was around 9%, and then because of global financial crisis it fell below to 5%. RBI globally everywhere started reducing interest rate, and India also we reduced interest rate. So the repo rate fell very sharply. Then economy recovered, it was hiked to again 8%. Then because of lower inflation, repo rate gradually it came down. And during COVID time, if you see that in 2020, repo rate was around 5.15%. And when COVID came, here also we reduced interest rate drastically to 4% from 5.15 to 4%. In 2 steps, RBI reduced the repo rate. Now it has hiked to 4.4%. Now the first hike has come. And to go to pre-COVID level was 5.15. For that to go to there, another 2 hike is possible. That is in month of June and August. So June and August, our interest rate will go to pre-COVID level. Now inflation is very high, near to 8%. To tackle that, another 2 more rate hike in coming months after the 2 hike in next 3 months. So overall, repo rate is likely to stabilize around 6%. Is likely to stabilize around 6% by end of this calendar year. And after that, based on the data, RBI will take decision. So repo rate will likely to reach between 6 to 6.55 level. And the impact of rate hike on economy, generally when rate hike happens, it will have an impact on economy. Suppose if economy is doing exceedingly well, means rate hike will get absorbed. For example, between 2003 to 7, all rate hike has been absorbed by the economy because economy was doing exceedingly well. But that is not the situation now. And globally also at that time, economy was doing well, and our exports were doing well. Domestic economy was doing well. So all the rate hike has been absorbed at that time. But now it is not like that. Some impact we may see because of rate hike. Okay, the first point is that the ultra low interest rates are over now. Many of them used to tell that the housing loan is less than 6%, whereas inflation is around 8%, where people who are buying the house based on loan are seeing negative interest rate gains. They are seeing it. So that day has come to an end, and gradually the floating rate is going to go up in line with the inflation. So the days of ultra low interest rates are over. The second thing is that we all know that government is the biggest borrower than anyone, and any interest rate hike is first going to affect the government only, because their interest cost will go up from next year onwards, because whatever they borrowed last year at lower rate, that they may pay at lower rate. For next year, for current year and next year, they have to borrow at the higher interest rate. So the interest cost will go up from next year onwards. And the main important thing among the consumer is that the higher interest rate may deter discretionary consumption. For example, someone is going to buy a car, which is a discretionary consumption. What will happen is that because of high interest rate, either he may downtrade, that is, he may go to lower version of the car, or he may postpone his buying because the EMI will go up, which may not be possible for a lot of them. If you take 10 people, it may be possible for seven or 6 people to afford the higher interest rate, whereas the balance 2 or 3, they may not be in a position to afford the higher interest rate and higher EMI, which may reduce the discretionary consumption. So the overall, already the inflation is very high. Along with that, the high interest rate, which means higher EMI, this is going to be the perfect cocktail for demand destruction, because when inflation is high, already the product prices has gone up, and when interest rate goes up, EMI will go up. So overall, what will happen? That the demand will come down, because the persons who are on the marginal side, they may take a decision not to buy the products because of higher prices as well as higher EMIs. So this is going to bring down the demand, which ultimately will reduce inflation. That is what the RBI and global central banks are are predicting, and this will ultimately may lead to some demand softening in coming months. And this high inflation, if you see, it is going to affect everyone, from a common man and to those who, for majority of the population, I may say like that. For I will tell one example. See, where I used to go for regular shopping, 3 months back, this Dove Hindustan Unilever product, Dove soap, the product price was around 330, 340 rupees. Four soaps of Dove soap is there, 125 grams. Additionally, they will give another one soap as free. It was 330, 340 rupees in that range. 2 months back, the same soap, they hiked the price to 380. When I went to last week to the shop, the same soap, it was put as the price has been revised to 430. So from 330, 340 rupees, the price has increased to 430, almost 20 to 30% jump in product prices in the matter of 6 months. So that is what the real inflation is. And and those who can afford, they will buy, but some of them may feel that the price is too high. What they will do, either they will buy a single pack for time being, or they may switch to lower priced soaps for time being, because the price has gone up so much that the down trading will start happening, or that they may go for a smaller ticket size. Instead of buying 5 soaps, they may go for buying single soap, and next month they may buy another soap. So in that way, it will kill the volume growth of the companies. So just I told one example like that. If you see, many product prices has gone up significantly. Notebook prices has gone up by 30-40% because paper prices has gone up. Steel prices has gone up by almost 70-80% the last 1 year. Metal prices, everything has gone up. So when metal prices goes up, what will happen? The consumer durables like fan, mixie, everything has gone up by 30-40%. Textile, unprecedented rise in the history. Cotton prices has gone up by 100%. And when I go to my native place in Madurai, lot of textile manufacturers are there. Many of my friends also manufacturing, and they are telling that in their lifetime they haven't seen such a huge price inflation within short period of time, because cotton price has gone up by almost 100% in the last 1 year, and majority of the cotton sarees which are made of 100% cotton, it will go up by 50-60%, because cotton price comprise almost 50-60% of the total overall cost of a textile material. And because of that, what is happening, those who are buying 3-4 sarees, they may buy only 2 or 3 sarees, because the price, they come with a budget of buying 2,000-3,000 rupees. Previously they used to get 4 sarees, but for the same amount they will get only 2 or 3 sarees. So thereby the volume growth has started coming down, and that is reducing that is what it is called demand destruction, the huge unprecedented increase in prices. And one positive point we are seeing for the last 2-3 weeks is that the base metal prices have started coming down. Aluminum prices, copper prices, zinc prices, they have started falling. And that is why if you see some of the stocks like Hindalco, National Aluminium, all the metal stocks, you are seeing good sell-off for the last 1 week, 10 days, because the demand destruction started visible first on the metal companies, and metal prices have started cooling off. So this may be the first sign of cooling of the actual prices, and that will get reflected in the inflation in coming months. So whenever RBI hike interest rates, it will get visible in two markets. The first one is the forex market, and second one is the bond market. And if you see in the bond market, now the 10-year Indian GSEC now has come to around 7.33%, and it has comfortably went above to 7% now. So during COVID time, it fell below 6. Now it has gone to 7%. So what is the expectation among analysts is that it may stable around 7.75 to 8%. Though repo rate there is a possibility of going up by around 150, 160 points higher from what it is now, around from 4.4. It may reach to 6%. The bond yield may not go up further by 160% because it has already discounted the higher interest rates, and it may go up by around 50, 60 basis point. It may go up, whereas the repo rate may go up by 160 basis point. Rupee dollar, if you see that rupee has weakened and at nearly to an all-time low of around 77.2 to 77.5 now. But relatively speaking, rupee has been stable when compared to other currencies. Some of the currencies like Japanese yen and Chinese yuan and all fell very, very sharply. So rupee is somewhat stable relative to other currency. And here also economists are expecting that rupee may gradually depreciate to 79 to 80 levels to US dollar. So the next thing is the impact of stock market. The first thing we saw the impact on the economy. The impact on stock market, if you see that the big plus point now is that that majority of corporates are balance sheets are extremely strong. They have reduced the debt considerably, and many companies are almost debt free, and therefore the increase in interest rate, the impact will be very, very less this time, at least this time, because some of the high debt companies, especially which are in metal sector, they have reduced the debt considerably. For example, Tata Steel has had a debt of more than 1 lakh crore. Now their net debt is at 50,000 crores, almost 50,000 crores they reduced in the last 2 years. And the company is in no hurry to increase the capex. They still focus on further reducing the debt. And when I see the index companies, only 2 or 3 are highly indebted. The other companies are in an extremely strong position, so that any rate hike is not going to burden them with high interest rates. A company like Tata Motor has higher debt, around a net debt of 89,000 crores are there. Tata Power has some debt level around 40,000 crores. The other segment where debt level are higher is the telecom sector, Vodafone Idea and the Bharti Airtel. Apart from that, I don't see any index companies are having any worrisome debt they are having. If we leave aside the index companies, the other company which are having some high level of debt are some of the Adani Group companies, and all this debt came in the last 2-3 years only. They have a very high level of debts, and the rise in interest rate may affect them. Apart from that, I don't see it is going to affect majority of companies because the balance sheet is extremely strong. Maybe the working capital loan may go up in this year and next year, mainly because the cash flow has come down, and the working capital loan may go up in current year and next year. That is for corporates, whereas for consumers, many of them may feel the stress because their EMI will go up, especially those who bought on floating rate basis. Their EMI will go up. Right now RBI has increased just to 40 basis point, and we are expecting series of rate hike in coming months. So somebody who are paying 20,000 rupees EMI, it is expected that his EMI will go up by 15% by end of the current calendar year. That means, for example, somebody paying 20,000 rupees EMI in the month of April last, means his EMI will become 23,000 by December, because he would have chosen the floating rate. That means when interest rate goes up, his EMI will go up. And so 15% of 20,000 is 3,000 rupees, which means that either his income has to go up to that extent, so that he will not get affected. Otherwise, what he will do, he will reduce spending on some other items, discretionary items. On food items he cannot reduce it because it is a necessity, whereas on discretionary items he will reduce spending of 3,000 rupees in to balance his budget. So consumers may get affected, those, especially those who are having a tight budget, and those who do not see their earnings go up in line with the EMI go up. So part of consumers will feel the stress. On the stock market, the major thing is that will happen because of increase in interest rate is the valuation reset. That will happen in stock prices. So when in the last 2 years, many stocks we were trading at 70 PE, 80 PE, 90 PE. Some of the companies like DMart and all 150 PE. The justification given at that point of time by the analyst is that interest rates are now zero, so we should not see the valuation. And for India, even if you get 2%, 3% return in a stock, it will 3% is higher than zero, and so you should not see the valuation, and you should blindly buy the company. That is the justification given by majority of analysts who were justifying the high PE stocks. Now, when interest rate goes up, naturally the PE ratio from 150 it will start come to 100. Even 100 is very high. At least the PE contraction will start happening, and those who are doing formula based targets on a discounted cash flow basis, they will set an interest rate. So when interest rate goes up from 5% to 7%, naturally the terminal value will start coming down, which means that the target price will get adjusted lower because of higher interest rate. So the valuation reset has started happening in majority of stock prices. Especially it has happened mainly in US, because many loss-making companies were given huge valuation in the US, and all these stock prices has collapsed by 80%, 90% in the last 6 months in Nasdaq because of expectation of higher interest rate. That process has speeded up further in the last 1 month because of the extremely hawkish stand by US Fed. And the valuation compression, which is called valuation reset, that is a continuing process, and that process will continue for the next 2-3 months. This is the US Fed rate, and in the last meeting US Fed hiked by 50 basis point. From 0.5 they hiked to 1%. Now US Fed has already told that in the next 2 meetings they are going to hike interest rate by another 50 basis point. So it will go to 2% in the next 2 meetings. Then after that, it will go to 2.5 based on the inflation print. That will take to pre-COVID level, 2.5 when US Fed rate comes. And from there, based on the inflation, they have to again adjust their US Fed rate further upwards. And many of them are expecting that US Fed rate may settle around 4 to 5%, and based on the inflation they are getting. So another by the end of the current calendar year, interest rate may reach to 3%, and from there another 1 to 2% hike is possible, which will address the current inflation environment. And if you see the US consumer inflation, it is above 8%, and in the last 10 years, this is the first time inflation has gone above 3%. Previously, it was hovering in a range bound from 0 to 3, and inflation will go up and then again it will come down. So the Fed has continuously kept very low interest rate because inflation was not a threat for them at that time. But now inflation is a threat, and central banks has no way to hike the interest rate. And the other thing what market fears more than the interest rate is that US Fed is going to shrink the balance sheet. In the last 2 years, Fed increased the balance sheet from 4 trillion to 9 trillion, and because of that, the entire world was full of liquidity, which led to huge valuations for loss-making companies to get very high valuations. Companies like Zomato, in spite of loss-making, they got more than 1 lakh crore market cap. Now because of the excess liquidity available throughout the world, led by the US Fed, now they are going to shrink the balance sheet, which means that the valuation reset will happen. So the shrinkage of balance sheet will end the ultra easy monetary policy, which was followed by US Fed for the last 2 years, and the rich valuation of stocks will get derated because of the Fed move. That we have already started seeing it. Companies, the new gen companies, Zomato, Paytm, all these companies are seeing huge sell-off. This is the Fed balance sheet. Just before COVID, it was around 4 trillion. And if you see that, and because of COVID, the balance sheet size US Fed expanded, more than doubled from 4 to 9. They expanded, and now from there it is expected that it will gradually start coming down, and it is expected that it may stay, it will get around $6 trillion, and till then the liquidity reduction will continue. That is, every month Fed will keep selling, say, 60 billion, 70 billion worth of bond. That means that much worth of liquidity will get sucked from the economy. And US, you know that many of my friends are in US, and some of them have started getting panicking in the last because of the fall in the stock prices in Nasdaq. Many got fed up whenever I put some negative news on on our group about the stocks falling in the Nasdaq and all. They used to get fed up. They get irritated, and they will tell that don't put negative messages on them, because already they got wounded. Don't rub salt on the wound, like that. They used to give command. And unlike our economy, US economy has huge impact on wealth effect. What is mean by wealth effect is that, suppose you are holding a 20 lakhs worth of share, because of boom in stock prices, if it goes to 50 lakh, means you feel that you are richer by 30 lakhs, and you will start spending more than what you had 20 lakh worth of shares. You feel that you are wealthier by 30 lakhs, so you will go for a trip, and you will buy expensive car, and you will spend money lavishly because of higher wealth effect. Now that is got reversed. The 50 lakh worth of shares, now it has become 25 lakh, 20 lakh, like that. That means you feel that you have become poorer, and you will stop spending money because of negative wealth effect. In US, it will have huge impact. I have seen in 2000 .com bubble crisis, in 2001 and 2, US economy did extremely bad because of extreme negative wealth effect. And in 2008-9 also, it had the same negative impact of wealth effect, because most of the stocks fell. And if stocks fell like this, means in US economy, spending will get postponed, or spending will get cancelled because of negative wealth effect. Especially the fall in stocks in Nasdaq, number one. The second thing is the cryptocurrency, where in US majority of the people have invested, and in that huge fall has happened. The overall, the market cap of crypto has fell by almost 60% from peak. That means people are poorer by almost 60%, and that will have huge impact on the US economy. And with that, coupled with high interest rate, negative wealth effect coupled with high interest rate, it will have definitely some impact on the spending by the consumers, at least in US. So some economists are expecting that that recession may hit in US by mid 2023. That is generally whenever stock market falls after 1 year, recession will used to hit in US economy. Two reasons are there. We can tell that one is because of negative wealth effect, US economy might have gone to recession. The second thing is that market is discounting recession ahead of actual event. That is why the stock prices have started discounting. That is why the stock prices has fell. Like that also we can interpret it. So whenever recession comes, stock market used to be extremely negative 1 year before recession. That is what we are seeing now. And many economists are expecting recession may hit US by 2023. But unlike last time, this time US Fed don't have much tool to tackle the recession. In 2000, the interest rate was high. In 2008, when the recession came, the interest rate was high. So both this time, US Fed reduced the interest rate to bring back the demand. But right now, the interest rate is already lower, and you can't reduce the interest rate now. Instead, interest rate is getting high. So the one of the biggest tool available to fight recession, that is the monetary tool. There is a complete absence this time. So the only way you can avoid inflation has to come down. This is the US recession since 1950. So we have seen almost 10, 12 times, 10 times recession from 1950 in the last 72 years. In 2020, there was a minor recession when COVID came. Just 2 months of recession was there. So that is why it is not mentioned. So the previous recession we had was in 2007, in December 2007 to July 2009, where almost 18 months that at that time recession period was. So when recession comes in US, it used to be 8 months to 18-month period. And stock market reaction will be extremely interesting to see historically in during recession time. 1 year before recession, stock market used to give negative return. Majority of the times it has given negative return. But once recession starts, the stock market used to stabilize. It won't fall much when recession starts, and then it will start giving positive returns over a 1 year to 2 year period from recession when recession comes. So the majority of the impact when recession comes means it used to have 1 year before recession. That is what we are seeing now. So somebody is going to fear for recession means the stock price already we are seeing the impact on the negative stock market. So when recession comes, then there is no need to worry because stock market would have discounted the recession when it actually hits. Crude oil around $106 is extremely high and it is very negative for us. And it has to fall. The only way it can fall is the end of Russia-Ukraine war, and we are not seeing any news about it. Equity market flow, it remained very strong, almost 16,000 crores equity market flow, equity mutual fund flows are there. My worry is that, 1 minute. Whenever market falls very sharply, historically, if you see that the retail investors tend to back out from equities. This time, what I feel is that the systematic investment that will continue because they are putting 5,000 rupees, 2,000 rupees, 3,000 rupees like that. So that may continue. I don't see much impact on that. Per year, per month, around 12,000 crores inflow is there in mutual fund because of the SIPs. But lump sum, there is a possibility of inflow stopping it. And the second thing is that there is a possibility of some outflow from equity mutual fund also, because lump sum outflows may happen from corporate side or from retail side. So the equity inflows may get softened from here on, and until now, whatever FIs were selling, it has been bought by mutual funds as well as the domestic institution. So the counterbalancing force may get slowed down in coming months, which means that the fall will be very sharper and we will reach the bottom soon. If domestic institutions stops buying, means what will happen is that FIs cannot sell, and even if they sell small quantity, it will fall very sharply and more quickly we will reach the bottom because they could not be able to sell much. Right now they are selling heavily because there is a counter force of buying. If there is no counter force of buying means then we will reach the bottom soon, though the bottom may be sharply lower. Time wise it will be quicker, but rate wise it would be sharply lower. GST collection continued to be positive. So in GST collection also two theories are flowing on. Only because of high inflation, GST collection has gone up. That is one theory going on, and we have to see how it will be comes in the next few months. Exports, it is very strong, and every month we are seeing very good exports data. That is positive. On positive side, mutual fund inflow is positive. GST tax collections are positive, exports are positive, and result performance, if you see that, I will tell it's a mixed bag, and the companies are coming out with result, and it is a annual result. So till March, till May 30, they have time to announce the results, and we have to get more companies to come out results in coming days, and we have to see it. But till now, among 566 companies that have announced results, sales it has gone up by 23%, whereas the profit has gone up by 40%. So I will tell it is slightly misleading. The main reason why the profit has gone up this much when compared to sales is that almost 4 or 5 companies there has been extreme skewness in their results. The first one is the Adani Power. If you see that Adani Power, when compared to last year, this quarter they have shown around 4,500 crores in the range they have shown profit. Whereas when you take the March quarter of last year, their profit was almost in the, around 100 crore. So almost 4,500 crore difference. It has boosted the profit mainly because of one extraordinary one-time income they got due to favorable court order. And the second one is the Yes Bank. Last year, same time in the March quarter, they have shown huge losses, whereas this time they have shown some profit. So there has been from losses to profit. When you combine the overall profitability, it has increased the combined profitability. Similarly, Tata Steel from 6,000 crores to 9,000 crore, another 3,000 crores increase in overall profitability. Tata Motors, last year they have shown 5,500 crore loss during the same quarter. This time they have shown 1,000 crore loss. So 4,000 crore has shifted. So because of one big movement in select few companies, the overall profitability has gone up by 40%. And apart from that, the banking results has been overall good. ICICI Bank, even yesterday, if you see the SBI profit has gone up by more than 40%. Similarly, ICICI Bank profitability has gone up. Axis Bank profitability has gone up. So like that, because of banking sector and one-off from many companies, the overall profitability has gone up. But when you track individual companies, the profit growth is not that much of a sales growth. And main reason is that there has been a huge margin compression because raw material prices has gone up very sharply. They may gradually pass on in coming months. The other important thing I noticed in the current quarter results is that cash flow has been extremely poor. Whatever profit companies got, cash flow from operations, I mean, that exceedingly poor. Because whatever profits got, it has been locked in receivables and in inventories. Because all companies need higher inventories. The price has gone up, raw material price has gone up. So naturally, a company who used to keep 100 crore inventory, they have to keep 130-40 crore of inventory because raw material prices has gone up by 30-40%. So to the extent of raw material price increase, the inventory has gone up, receivables has gone up. So after many quarters, first time I am seeing that the receivables has gone up in many companies. That means the cash flow from operation is poor, extremely poor, and many of the companies, the working capital loan has gone up. That is why we are seeing that the credit growth have started increasing in many banks for the last 4 or 5 weeks, mainly because the cash flow from operation is very poor. So that trend is visible among majority of mid caps and even in some large caps. Some of the companies like Asian Paints also, I saw that cash flow from operation was very low when compared to last year. So the foreign portfolio investors, and if you see anyone, the main reason for selling, if you ask anyone, the first thing they will tell that foreign investors are selling in our market. Every day they are selling 3,000 crores, 4,000 crores, 5,000 crores, like that they are selling. The selling has not started in the last 2-3 weeks. They have been continuously selling for the last 7 months. After the selling started in the month of October, and it has continued till mid-May. Even yesterday, they have sold heavily. And if you see that 2 billion, 1 billion, 3 billion, and in the month of March, they sold more than 5 billion. And in the April, another 2 billion selling. And in the month of May, they have already sold more than 4 billion, almost 30,000 crores worth of shares they have sold in the month of May, which is just mid-May. So another 2 more weeks to go. We don't know how much more they will sell. and they will keep on selling it. If there is a counter buyer is there, right now mutual funds are buying, so they will keep on selling. But once when they stop buying, means what will happen? They could not be able to sell it, but price destruction will be very heavy. And this is the first time that they have been the continuous seller for the last 7 months. This is the 10-year chart, and if you see that in no period, FIs has been continuously selling for the continuously for 7-8 months. This is the first time they are selling continuously for the last 7-8 months in the last 10 years data if you take. And many of them are asking how much foreign investors can sell, and some of them are even telling that they would have sold 30-40% of their holding by this time, because they have sold almost 3 lakh crore worth of shares in our market for the last 6-7 months. They have sold it. But if you see that data, what they have sold in FY21, the inflow was 37 billion, whereas 22, 88 billion they have sold it, and 23, 5 billion they have sold it. So whatever inflow they made it in the year of 21, just they have sold 60% of the inflow they have sold. That means for inflow of FY21 to sell, to completely sell out, they may have to sell another 10-12 billion. They have to sell it. So they not even they sold whatever they brought in FY21. But on a big picture, if you see that FIs were holding around 550 to 550 billion worth of shares in our country. They have invested around 160 billion overall in our country, and their market value is around 550 billion. And in that, they have sold just 23 billion. That means just 4% of their holdings they have sold it till date, and still they have 96% of holding. So the FII is selling. When it will stop, it will depends upon the valuations getting so much attractive, like in COVID bottom, where valuations became so attractive that counter buying started coming in spite of there was no vaccine invented at that time. Still buying started coming in, because the valuation fell so much that value investors start coming in. And so till then, the FIs may continue their selling, that they may bring down the valuation to so attractive levels. So till FIs stop selling, we are not going to see the bottom in our market. So that is an extremely negative scenario. So when whoever talking in TV or in social media, I see that everyone is extremely negative. 10 out of 10 people are extremely negative. Maybe almost 100% people are negative, and many are holding cashes. Cash levels are much higher this time in anticipation of further fall. So there could be a trigger for sudden turnaround in market. One trigger that could just make the market to see an U-turn is the ending of Russia-Ukraine war. Suppose if any compromise happens between Russia and Ukraine on war front, market will see a sharp upturn, because many people are holding huge cash level, and many FII net long is just 17-16%, which is historically the lowest I have seen. And if that is the case, if any positive news that could trigger, means the one news that will trigger is the end of Russia-Ukraine war. We don't know it will come or not, but if that comes, we may see sharp upturn in market, because right now market is falling mainly because of the high inflation. The culprit for the high inflation is the supply chain disruption, which is mainly due to Russia-Ukraine war. And if that comes, means market start discounting the future lower inflation rate, and that could trigger the market turnaround. That is that event will be very crucial to watch, and if it happens, it will be very important. The second thing is that right now in the last 2 years, 3 years, if you see that there is a big word on anti-globalization, that each country want to become self-sufficient by itself, and they don't want to import, they want to reduce import. Like that, these talks are there. Now, if there is a talk of again globalization, means then that will also act as a positive trigger. Even last few days back, US President Biden told that they are thinking of reducing import tax from China, which levied a few years back to reduce import from China. And since inflation is very high, they are planning to reduce the taxes, which means that again they are talking of globalization, increasing globalization. And these type of statements are positive for the market. The other important thing why we are seeing so much of very negative, very high inflation is the switching to green energy. Because of switching to green energy, what happened? Many coal plants were closed, and people were having the have been putting the solar power plant, which are costly, and green energy comes as a cost when compared to the dirty energies. And main reason why the energy price has skyrocketed in Europe is the switching to green energy. They closed all coal-based power plant, and they closed nuclear power plant, and because of that, the energy cost has gone up very sharply. Suppose if there is a postponement of switching to green energy, means then the energy cost may come down, and that also will reduce inflation. So these are some of the triggers for the market to turn around. And the main trigger I see is the end of Russia-Ukraine war. No one knows when it will happen. Suppose if that happens, means then we will see a very sharp up move in the market. The final slide. So what investors should do now? Everyone can give running commentary on the market, that now market is falling because of inflation going up, because of US Fed hiking interest rate. That thing everyone can give, all economists can tell, everyone can tell. But what we should do, whether we should sell all the shares now and should be in cash, or we should buy now because of market prices has come down, and what we should do. So in my opinion, what we should do is that it is impossible to predict market bottom, and I have seen in the last many cycles that no one can predict the market bottom. But seeing the way stocks are falling here in our market as well as in US, if you see that the bottom will reach much sooner than anyone expects, and I expect maximum 2-3 more months of maximum 3 months of hard time is there. But by that time we will reach the bottom. Either stock price would have crashed so much that the price would have reached the bottom, or some positive news we may start getting it. So either two things are possible in the next 2-3 months, and bottom will reach soon. And by the time when bottom comes, no one will tell that we should buy. Everyone will tell that all negative news only. So the best way to utilize a bear market is that you buy a company which you feel holding comfortable. If valuations are very attractive and dividends are attractive, without looking into macro economy, one should buy it, because no one will tell that it's time to buy, because no one actually knows it. The only way to buy is the buying shares at the attractive valuations. So couple of weeks back, Berkshire Hathaway AGM were conducted, and in that Warren Buffett, he told just only one thing only: he will buy shares when valuations are attractive. He won't chase for buying simply because prices are going up. So his success mantra is just only one point only: he will buy a decent company when valuations are attractive. Even if you go wrong, your loss will be much less. In near term, stock may fall further after our purchase, because no one knows the bottom. But near term, if a stock from 200 rupees, it has come to 120 level. After our buying, it may fall to 100 rupees or 90 rupees in near term. But after 1 or 2 years, if you see, definitely you would have gone to 180, 170 level. I'm telling about good companies. I'm not telling about companies which are manipulated. A decent company which gives a dividend, which have decent business model, which has long-term potential. So one should start buying without looking into the market bottom. Gradually, you should buy. You should not buy tomorrow itself. You should not buy 100%. You should buy 10%, 15%. But not buying in a bear market correction, it will definitely be a costly mistake, because only in bear market only you will get stocks at an attractive price, and you can gradually buy also. In bear bull market, what used to happen? You think of buying a stock at 200 rupees. Morning you will come, the price will be 205. Instead of buying 100 shares, you will buy 50 shares. The price will go to 215, 220. So you won't get an opportunity to buy a share in bull market at a price you wanted. Whereas in bear market, you will get a opportunity to buy a share at a price you wanted, sometimes lower price at what you wanted. So you should not miss a bear market. It should be used as an opportunity to buy it. Definitely near term some pain will be there, but ultimately what will happen after 1 year or 2 years, if you see, definitely price will be much higher than what you would have bought. So that is my advice, that gradually you buy over a period of time in bear market without looking into short-term losses. Over a period of time, definitely you will make money. And events to watch: results and global markets. Results are coming in another 2-3 weeks. Another 2 weeks you will get the results. And this time what interesting is happening is that when results are good, stock prices are falling by 5-10%, and when results are average, stock prices are falling by 20-30%. If results are bad, it is falling by 40-50%. So even if results are good, the stock prices are falling, the fall is less. So you will get an ample time to research a company, and you will get an and buy the stocks. And global market we have to see, and if some stability comes into global markets, then we may see stability in our markets also. So this is my presentation.